Decision attribution analysis is the next frontier when it comes to identifying and understanding investment skill. Performance attribution starts with a performance outcome and attempts to explain it by working backward, comparing it with a passive benchmark. That's one way to look at it, and it's kind of the only way if all you have access to is monthly performance data. And performance attribution is helpful for explaining why a manager made or lost money over a certain period. But it's not very helpful for understanding what the manager was actually doing and to what extent that was responsible for the performance outcome. That's actually frustrating for the manager, and it means that the allocator of capital is taking an immense leap of faith in deciding to hire the manager. Decision attribution analysis comes at it from the bottom up, taking into account every trading decision the manager made over the period. In truth, the stock picking decision is not the only decision they're making. The picking decision is an important one, but there's an array of sizing and timing decisions that the manager makes over the life of the investment. And the impact of those decisions can make a significant difference to performance if you look at them in the aggregate, even for a very low turnover manager. No matter which type of decision is being considered, identifying skill is a matter of looking at hit rate and payoff ratio. Hit rate looks at the percentage of decisions that have resulted in outperformance. Ideally, that would be at least 50%, right? But that doesn't necessarily have to be the case. In fact, most investors get their decisions wrong more than 50% of the time. Payoff ratio looks at the value being added by the average good decision divided by the value being destroyed by the average bad one. You want that to be over 100%. In fact, it kind of needs to be if you're going to make money. Looking at it this way gives you a lot more data points to work with, and therefore the ability to identify skill without relying on a 20-plus year track record, which is what you need for performance attribution. Now, logically, somebody whose decisions are adding value at least 50% of the time and whose good decisions are adding more value on average than their bad decisions are destroying is going to outperform over time. Not only that, but Essentia has found that, unlike performance, the quality of investment decision-making, as measured by Essentia's behavioral alpha score, is persistent. Investors who have been making good decisions over the last 3 years are more likely to carry on making good decisions than those who haven't been. Common sense, really. But decision attribution is saying that the manager's job is to make decisions. And if they make good decisions, the performance outcome will follow. If you're an allocator of capital, decision attribution analysis is a unique and powerful lens on whether the manager is actually doing a good job, regardless of whether the current market environment favors their style. And if you're a manager with a clear decision-making skill, in other words, a behavioral alpha score over 50, you've got a powerful proof point that creates clear differentiation in the market. And if you're a manager with a lower skill, what you've got is a baseline for improvement, and we can help. All managers have the data required to do decision attribution analysis. In fact, without it, they're kind of flying blind. And while allocators without segregated accounts may struggle to get access directly to the data required, they're finding that even just asking questions about it is adding value to the process as they decide which managers to entrust with clients' capital. To learn more about how your firm could be using decision attribution analysis, come see us at essentia-analytics.com.